since we are still in the middle of the global financial crisis, it is most appropriate that we have a special session on the macroeconomic situation in China. Our first speaker is Ligang, the director of the China program at the Crawford School. Ligang is going to talk to us about the macroeconomic performance of China in the aftermath of the global financial crisis. Ligang.
Thank you very much, Win, and good morning, everyone. This is this year, and we set up the theme for in discussing the long-term issues of Chinese economy in the 20 years of reform, next 20 years of reform and development. But we have a tradition to discuss the latest macroeconomic stories and add update. And it used to be that this is the job for Yiping, but this year he can't make it. So I just step in and to brief you about what's going on in the latest macroeconomic in China. Professor Yao Yang mentioned about a magnet train this morning, very high speed. In fact, the maximum capacity or the speed of that train is 435 kilometers an hour. So the speed actually we can refer to what happened to China in the past 30 years. Very high growth rate. On average, it's about 10% per annum. So in the past 30 years, we have experienced the financial crisis in East Asia, and now the global financial crisis. So in that context, we discuss what happened, the real impact of the global financial crisis on the Chinese economy, and also the timely and effective policy responses by the government in China. And we present this data to show that is how China can achieve or could already achieved a V-shaped recovery, which is quite extraordinary. And but also we point out some associated risk in doing so. And then I would like to emphasize a bit about what happened in the external environment in which China economy or the macroeconomic policy have to manage through. And then what's the macroeconomic policy adjustment. And importantly, we point out the importance of the exist strategy and giving the background of the massive stimulus package in China. Finally, perhaps the message is that why is this important for the international adjustment to take place in order to facilitate the structural adjustment in China. So that's roughly the outline of my presentation. Now, give you a bit of data to show the real impact of the financial crisis on the Chinese economy. So this is about the data on a quarter-on-quarter basis, the growth rate of GDP since 2000, the third quarter of 2000, to the very latest, basically the second quarter of this year. We can see the growth is slowing down, actually not resulting from the current financial crisis. In fact, there is an overheating economy towards the end of 2007. So the government already adopted certain measures in cooling down the economy. So we can see that at that time, the growth already starts slowing down. That's well ahead of the financial crisis. But the financial crisis in the second half of 2008 accelerated the pace of slowing down to the extent that in the recent years, it never happened in China to see such a fall, a big fall of growth rate of GDP as a result. Of course, the data also show that there's a clear pattern of a V-shaped recovery that, of course, is resulting from the very big stimulus package adopted in China. I will come back to that shortly. But just look at the shape of the falling of the growth rate over that period, which is quite dramatic. That's a real impact. I think the lowest growth rate is reached by 2009, in middle of 2009, about something like 6%. And it used to be economy was also saying, in case of China, growth rate of GDP, is a minimum level of something around 6%. And below that, will be hampering the growth rate, the process of economic transformation. So it's quite dangerous. That's perhaps also illustrates the background why China adopted such a dramatic measure in combating that global slowing down. And that's another data to show the growth rate of industrial production consumer goods sales, and fixed asset investment. So the red line is the industrial production. You can see it's just falling over that as a result of the financial crisis, and the sales is also falling. But most extraordinary thing, you look at the data, is the black line and on the top, which shows that the fixed asset investment increased dramatically, resulting from the stimulus package. So almost adopting all the measures at the disposal, not just the physical, but as well as the monetary policy and the credit expansion. So all showing that is the resolute of the Chinese government in dealing with the negative impact of this crisis. And we can also see the data to show what happened to the export. This is the growth rate of export and imports and month on month. And again, this is quite extraordinary. And this is actually traces back to the middle 1990s. So that is also covered experience of the impact of the financial crisis in East Asia. But you can see the extent of a falling export or trade is actually much deeper than what happened more than 10 years ago in East Asia. So that's why it's, we're talking about a model, the growth model of a Chinese economy, and external driven, and this is actually, you can see the shock to the economic system. And it's much more deeper than the previous crisis. And also, you can see that there's two lines. One is about export, red line. The other is the import. The import is actually falling more sharply than export. What's the reason for that? The reason is that it's reflecting the nature of China's processing trade. That means a lot of trade actually rely heavily on the imported goods. So when the exports start falling, that also impact more on the imports. Of course, this data also show the V-shaped recovery, quite dramatic. Until probably, I think, very latest last month, the export is researched. But again, later on, I point out that is may not be that kind of optimistic about medium-term prospect of the export market growth. At least now we can see that it's very clearly there's a V-shaped recovering of both import and export. That's the trade. And this is related to the macroeconomic story, the global imbalances. That what happened, we know China need to adjust to the so-called current account deficit and a surplus vis-a-vis the United States. But this is the monthly trade balance. We can see also quite interesting in the back to the middle 1990s. At that time, during the financial crisis, the trade balance never go to the negative territory. But this time, it's a very in the very first the quarter of this year, we can see that it happened. That means the financial crisis does have some impact on the trade in terms of their structure. That's another one. Now so that is the impact on the growth, on production, and as well as on trade. So the government actually responds very quickly in order to deal with that crisis. In November 2008, which is only 7 weeks after Lehman Brothers collapsed, so the stimulus package put in place by the government in China. So this is quite well known. So I don't have to go detail of that. So basically, consisting of jointly by central government and local government, and it's a massive stimulus fiscal spending program going on, and 30% from central government and 70% consisting of the investment from a local government. There's a kind of a composition of that $4 trillion yuan package in terms of the spending. And we can see the railway and the infrastructure development accounted the largest share in that package. So that's the background of that. And as a result of let me just mention about a couple of other information. The first one is about the ratio of a physical deficit to GDP. So people worry about whether there's affects the so-called physical sustainability of the government. But if we can compare right now, the current crisis with the previous crisis in East Asia, we can see that the extent of the deficit, the ratio of the fiscal deficit to GDP is actually is smaller than the previous one. So there's an issue there. I think Professor Yao Yang mentioned this morning about a huge amount of public funds available for reinvestment. So on the fiscal front, it seems to be quite safe. And the second one is about the monetary policy adjustment. Again, this is put into context about financial crisis in East Asia and the current crisis. We know that is perhaps that also illustrates why the fiscal measures are necessary. And in the previous crisis, the central bank reduced the interest rate almost 7 times. But at that time, it didn't work very much. And so therefore, as a result, this is dealing with the previous crisis, government also rely on the fiscal means. And similar things happened to this time. This is towards 2007, we can see the acceleration of the real exchange rate. That is referring to the background I just mentioned about dealing with the overheating of the economy. But after that, you can see the exchange rate is actually falling. This provides a background for us to look at the issues I'm going to discuss later on about the real cost of borrowing later on. Because when you have a set of very low interest rate and with a rising price level, the real cost of borrowing will be negative. So that's behind a part of the problem in the economic structure in China. And not only the physical things, but also the monetary expansion. This is the growth rate of M2, the money supply, and the bank loans. Again, it's on month-on-month basis. So you can see that since 2009, that's extraordinary, the credit expansion happening in China. That actually was kind of causing some anxiety and worries about the inflationary pressure. And this is actually exactly the point, and which is associated with the credit expansion, and on both fronts. Now, this is I think morning session already mentioned about the physical infrastructure, investment in infrastructure. This is a newly increased capacity for road and railways. And so it's just extraordinary. You can see the shape of change, and in terms of kilometers of both highways and railways in China in recent years. And monthly production of steel and automobiles. Again, there's a slightly, kind of a falling trend during that crisis, but very quickly that the production are picking up. And so you can see overall is still follow the long-term pattern or the trend of the production. So that's reflecting the V shape of the recovery. So why the stimulus package was effective? We ask this question. I think scholars probably just summarize in the following way. The first one is about experience. The experience gaining in dealing with the financial crisis in East Asia is considerable in terms of designing and implementing the stimulus project, especially at the local level. That experience are very valuable. The second one is the aligned interest, meaning that the central and local government interest in favor of a new stimulus package is really well aligned. So in a way that is both kind of come to the realization that it's very necessary for government to do it. And the third one is about the funding. Unlike the banking system, a problem back to 10 years ago, people worry about the banking system in China. This time, banks are relatively robust, so and provide ample liquidity to help fund the government mandated lending. That's another one. And fiscal position are already referred to. But also an issue about the starting point. So China was not, unlike the United States, China was not over-leveraged when crisis hit. Meaning that when you have a stimulus package spending, that spending can translate it very quickly to real aggregate demand. And in the United States case, a lot of a stimulus package is actually for the purpose of deleveraging, so rather than translating into the final demand. So that's why the stimulus package is rather effective in China. But what are the downsides? Let me just quickly, couple of minutes, to highlight the three kind of downsides. The first one is about what happened in China in dealing with the crisis. And we see that it is the blue line. You can see since 2008, the share of state-owned enterprises in the total fixed asset investment is actually increasing. So this is somehow against the trend of economic transformation, moving towards increasing share of a non-state sector. But people may say that as well. This is the crisis. We have to deal with that crisis. And by the way, all the stimulus package actually starting from driven by government. But that highlighting an issue about so-called crowding out of the non-state sector development. That's a big issue right now. So if China, this is also the issue behind the so-called exit strategy from the stimulating package, and to create more room for the non-state sector development rather than continue to focus on SOE. So that's one of the downsides. The second issue, of course, people nowadays are very common to talk about the inflation, and both CPI and the PPI picking up as a result of that very quickly. And this is kind of, again, potentially quite dangerous of the inflation pressure down the track. But this is also related, I think Professor Tyers will talk about that issue, about the real exchange rate. So we can see there's a blue line is about the nominal exchange rate, renminbi per US dollars, and the right one is the nominal effective exchange rate of China. The data shows that, of course, we know it's well known China is a pact, the yuan is a pact to the US dollar for a long time, until 2005, July 2005, and then after that is appreciating about something like 20%, and then since 2008 it is a pact again. So that means if China doesn't adjust nominal exchange rate, so another way of adjusting is what? Is to increasing the prices. So that is this is a real issue about when you have a packed exchange rate and the central bank is losing the independence of a monetary policy. So as a result, the price tend to be increased. So that's another downside. And the real estate bubble, I think we'll have only 2 minutes, and it's a real issue there right now for China. You can see the share of total GDP is increasing. But importantly, it's a speculative, almost like what happened in the past few years to the stock market in China. The real estate market also become very speculative. So a lot of vacancies now in apartment, an enormous amount. And the electricity companies, they checked the meters for electricity. A lot of apartments actually have zero in the past 6 months. So in the case that is on the one hand, we have a huge demand there in China, but on the other hand, you created such a bubble in the sector. That's another downside, again, the similar thing. So another uncertainty is associated with Europe. And we know what happened to the Greek crisis, and perhaps with the possibility of spreading over to other countries. So what happened in the past few months is the depreciation of euro, something like about 14%. And so that means renminbi is under pressure to reevaluate. And the European market is one of the largest markets for China's export. So depreciation of a euro actually put China's export in a very bad, awkward position, because in dealing with a bilateral imbalance with the United States, something happening, you have to readjust. So European market play a crucially important role for China. But right now, you can see the exchange rate changes that affect. And this data shows that in picking up from the crisis, European market actually play a very important role. So that is a bit of uncertainty. Finally, the potential problem. Number one is about industrial sector. This is the overcapacity. Basically, in certain industries, and resulting from the low cost of borrowing, and I referred to the negative real interest rate before, but also resulting from the retention of a profit by large size of SOEs. And that trend kind of continue, especially accelerated by the stimulus package. And so that highlighting some potential structural problem. The second one is the commercial bank. As I said, the commercial banks looks rather robust, measured by the relatively low share of the non-performing loan. But however, the majority quite a large proportion of the stimulus package, especially driven by local government, is coming from through the bank loans. That means anything wrong with the bubble, anything wrong with the investment, were resulting from the higher increasing share of the non-performing loan. So it's not that we have to be very cautious about what's going on to the banking sector. And of course, local government also an issue about the fiscal risk. Finally, yes, government need to adjust. Finally. So at least a few things. But let me just emphasize two things, perhaps. The first one and the final one. The first one is about exit strategy. So probably it's the time. Given the sign of overheating, so government needs to start doing that process. And especially, by reforming and providing more opportunity, lending and loans to non-state sector for doing that. But it's not as clear about how, to handle that one. Finally, it is about the role of international adjustment. We know the bilateral global imbalances happening. So China actually, all the things they're highlighting that China is start adjusting. But we also need the adjustment on the international side, especially the United States. There's a lot of things going on, dealing with the crisis and etc. But it seems to be that it's still lacking a very clear policy framework in the United States in dealing with that, the structural problem at a deeper level. And because it takes years for this structural problem to be solved. So therefore, yes, I think on both sides need to get its priority right. Thanks, Ben. Yeah.
Thank you. Our next speaker is Professor Meng of the Research School of Economics at ANU. We are very lucky to have the world's leading expert on China's labor markets to tell us about the human dimensions of the global financial crisis in China.
Thank you. The topic of today's talk is searching for the adverse labor market effect of GFC in China. And this accurately describes the process of our research. So I'm going to lead you through the whole process. We were stunned, and then we suddenly dawned, and then we find out exactly what the effect was. And then we also can have some implications for this year's seemingly labor shortage issue. So in this talk, I want to talk two questions. One is exactly what is the effect of financial crisis on the labor market outcomes of the mostly heated group, that is rural-urban migrants. And then the second question is why just immediately after this financial crisis, we're already seeing a sign of labor shortage. So these are the two questions we're going to answer. That hypothesis actually is afterthought, so I'm not going to talk about that. We are very well equipped to discuss this issue because of this rural-urban migration in China and Indonesia project. In that project, we conduct surveys of rural household, urban household, as well as migrants in the cities. And this is probably the only available representative sample of Chinese labor market. And it's sponsored by USAID, ARC, and Ford Foundation. And in this talk, I'm going to use two samples. One is the rural-urban migrants in the city and the rural household in the rural area. So at the beginning of our thought was, okay, the export dropped by 20%. The most heated group will be the migrants. So let's look at what happened to migrants in the city. And we find there's a slight increase in unemployment, around 2 percentage points. And there's a small shift from wage and salary workers to self-employment. These two things all happened in the Asian financial crisis in Indonesia. That is, people move from formal sector to to informal sector. But the size of the effect on employment is quite small, given that the exports dropped by 20%. So we thought perhaps all the adjustment was in the wage. So if wage was reduced, then that explains what was the effect. But surprisingly, we actually find that for wage and salary earner, in 2009, when the global financial crisis hit, the wage increased by 15%. And we tried very hard to find exactly what happened, but this is real. We couldn't find anything, and actually inflation was negative in those years, very small negative. So, and then it suddenly dawned to us, we're not looking at a normal economy. We're looking at a dual economy. So migrants in cities, given not only it's a dual economy, but it's a special dual economy. That is, migrants in cities are treated differently from local people. They do not have unemployment benefit. They do not have any other support. Once they lose job, where do they go? They go home. So that leads us to look at the rural situation. So what happened to rural area? We find that out-migration reduced by 2.3 percentage points. That translates into real number. It's around 11 million people who would have migrated but did not because of the global financial crisis. That's a lower bound of estimates of the effect, because in the past 10 to 15 years, on average, the migration increase is around 10%. So if we add that into this calculation, we estimated around 18 to 19 million people did not migrate because of the global financial crisis. So that's the real effect here. And then we ask a question, okay, these people did not go, or some people actually went and come back. In 2009, they went to the city to work, and in 2008. And in 2009, they came back, they didn't go. What did they do? We find that 80% of them went back to agriculture sector. And then we calculated how many days they actually worked in the agriculture sector, 55 days. So it's 1/3 of a year they worked in the agriculture sector. And this is for people who migrated in 2008 but did not in 2009. And then we look at, on average, how many days agriculture people work. That's 150 days. So half of the year, they have nothing to do. What about the off-farm jobs in the rural area? What we found is off-farm job during this period also reduced in the rural area. So local shops, services, and also local factories. The job also reduced dramatically. We calculated it's around 26 million people lost job because of the global financial crisis in the rural area. And we look at the hours, we look at the wage in the off-farm job, there's no effect at all. And then I will tell you why we think this is the case. So if we summarize what we found here in the rural area, we know there's a reduction around 18 to 19 million people who would have migrated did not because of the financial crisis. We also found a reduction of off-farm job by 26 million, and also significant underemployment in agriculture sector, around 50%, and no effect on hours or earnings in rural off-farm jobs. And we also, because of the timing issue, I can't talk about income. We also find that there's a significant income effect. So exactly what's going on? We decided to pull everything together, and here is our story. So the global financial crisis hit China at the end of 2008. And by 2009, Chinese New Year, when all the people go back to visit, the global financial crisis is in full swing. And migrants' expectation of obtaining a job after the Chinese New Year, it's very, very low. So lots of them take that into account and decided not to move out. And they stayed in the rural area. And there's a significant reduction in the supply side of in the anticipation of the deeper financial crisis. So this is what happened to the supply side of the labor force. From the demand side, in the mid of 2009, the stimulus package has already started to work. And that increased the demand in the city for migrants. But because of the supply shortage, we see the increase in wages over there. So if you only see the wage increase, you will be very surprised. How come? And what's going on? And this is the detailed information we need to know to be able to get down to the bottom of the issue. So therefore, but in the rural area, I told you before, there's no off-farm job wage impact. This is because in the rural area, the labor supply is instant. There's information that we need labor, people will come from agriculture sector, right? So therefore, we didn't find, okay, 5 minutes, find any the wage increase over there. But the increase in return migration reduced rural income, and I didn't talk about this in detail, but in the paper we talked about this. And all the effect of global financial crisis on employment was borne by the rural agriculture sector, where a significant underemployment was observed. So what about the labor shortage in 2010? I think migration costs for return migrants have increased as a result of global financial crisis. This can be seen from two perspectives. Physically, they moved back, they settled, and then you say, come out, and they say, well, I'm having a baby, I'm having a family, so I'm not going. So that's a possible route. The other thing is once bitten, twice shy. Well, last time it was bad. I didn't want to be like that again. So there's a possibility that the delayed supply of labor force generated this effect. Because of the lack of social welfare provision for migrants in cities, migrants adjust instantly to the adverse demand effect in cities by returning to rural area, but a positive shock in cities may not receive the same degree of adjustment, the same speed of adjustment due to the risk aversion. So the huge underemployment in agriculture sector indicates that there could not be any real shortage of labor. The main problem should be related to labor market friction generated by institutional barriers. And I think I'm very happy to hear that Ross has changed his view from turning point to turning period. The period can be 20 years or 30 years. So I'm very happy that I somehow maybe convinced him it's not the point yet. The other evidence we have to say that there's a labor shortage in 2010 in the urban area is in 2007, before we conduct our survey, we did a census of 15 cities, how many migrants there were. And then in 2010, early this year, we also did a similar census in the same cities. And we found that on average, there's 17% reduction in number of migrants in those cities, suggesting that migrants are not migrating as much as they could. And also, this number might be a slight underestimate of how many migrants actually there were, because the city boundaries were expanding. So we are currently conducting expanded boundary census, but that number should not change that much. And the other interesting outcome from this census comparison is the reduction of migrant supply mainly occurred in the coastal cities, whereas in the interior cities, the degree of reduction in migrant supply is smaller. So finally, main lessons. We think the dual economic system seems to have cushioned the global financial crisis impact in cities by moving open unemployment from cities to the countryside and disguising it as underemployment in the agriculture sector. Secondly, we think, in essence, it does not resolve any real problem for migrants. Returned migrants and their families suffered from considerable income loss, and the multiplier effect of returning migration affected rural off-farm jobs. And the last point I want to say is the geographic distance between unemployed people and jobs implies that employment readjustment to a demand recovery take much longer time than what it normally would. So the cost to the economy may well be higher than setting up an unemployment support for migrant workers. And the last point I want to say is, we don't think the unemployment support should be like a Western society. We think we should just set up a bottom floor support to everybody who needs support, be old age, be unemployed, be just very poor, be very sick. So that's all.
Thank you, Meng. Our last speaker, we welcome Tyers home from Western Australia. He's going to talk to us about the exchange rate regime in China.
Thanks very much, Wing. I am cognizant that this is the last session before lunch and that tummies may begin to rumble. The chapter in the book on this subject has a number of topics I won't have time to cover here. What I'd like to do is to give emphasis to the changes over time in China's underlying real exchange rate, and leave the controversies over the renminbi for your reading. You'll see that those things are very closely related in any case. The paper is joint with my colleague at the University of Western Australia Business School, Ligang, and it also builds on joint work I've done, and some of which has been presented in these conferences in the past, with Jane Golly and Ian Bain, both of whom are here, and also with Lu Feng, who is at the CCER at Peking University. So what I'll begin with is a couple of quick definitions and a very little bit of economic theory. It's a difficult subject, the exchange rate. In order to understand the meaning of changes in the real exchange rate, it's important we have the same view about its definition. And the definition I'm going to use here is the financial definition. If we think of the nominal exchange rate as being the amount of foreign currency we get when we give up 1 unit of our own currency, then we'll think of the real exchange rate as our giving up one representative bundle of home products and services and asking how many correspondingly representative bundles of foreign goods and services we receive in return. So it is translating the nominal measured in money into the real measured in goods and services. And it turns out this is simply measured as the ratio of the GDP prices, or the average price of all goods and services in the economy at home and that abroad. The P star is the foreign GDP price, or GDP deflator. And here you have to divide the denominator by the nominal exchange rate in order to have a common currency ratio of the two. This gives us this very neat little relationship. It's by definition, there's no economic theory here, that tells us that the real exchange rate, which I call the lowercase e, depends on the nominal exchange rate multiplied by the home GDP price. And if we think of the home economy as being unable to influence the behaviour of the foreign monetary policy and therefore the foreign price level, then we can think of the P star in the denominator as being exogenous. Now, the important thing about this is that the nominal exchange rate then depends on monetary policy. The real exchange rate depends on just about everything that happens in the economy. And if I have time, what you'll find is that my presentation today about the real exchange rate will come around and relate quite closely to Meng Xin's presentation previously, that is, closely to understanding what's happening in labour markets. Now, normally, when we have a discussion about exchange rates, we have the financial view that exchange rates are unpredictable almost by definition because the trade in currency depends on expectations, and if everyone's expectation uses all available information, then there is no information content left in exchange rates, and therefore they are unpredictable. That is the efficient markets hypothesis, which, as you know, took a little bit of a battering in the last 2 years. China is different from this in the sense that China maintains quite strong capital controls, quite effective capital controls. And so the movement of financial flows in and out of China is heavily regulated by government, and those controls are comparatively effective. And that makes China's exchange rate behaviour clearer and a little more predictable, particularly its underlying real exchange rate behaviour. So in essence, what happens is that the real exchange rate is a real variable like others in the economy, and it responds to shocks that occur, all kinds of domestic supply-side shocks or shocks like the global financial crisis affect the real exchange rate in a way that is truly endogenous. That is, governments and central banks cannot control the underlying real exchange rate. But once it has shifted, and say here we have an appreciation of the real exchange rate, then the monetary authorities have the choice of either allowing the nominal exchange rate to appreciate or to allow an inflation to take place. If they want to maintain a fixed exchange rate regime, then the consequence of a real appreciation is an inflation. And that is indeed what happened in the last year, and to some extent, although the nominal exchange rate was appreciating in 2007 and 2008, the high inflation of that period suggested that it wasn't appreciating enough. Now, when we think about understanding the determinants of the real exchange rate, there's really only one simple body of theory, and it's a very elegant little theoretical hypothesis by Balassa and Samuelson. And it's a useful starting point for us to think about, does the behaviour of the Chinese real exchange rate concur? In fact, what we find is it doesn't, and I'm going to lead on to two puzzles I'll try to help resolve over the behaviour of China's real exchange rate. Under this hypothesis, we think of services as being non-traded and as being equivalently productive internationally. We imagine that labour moves so as to equate wages between the services sector and the manufacturing or traded sector, and that we have tradable products arbitraging perfectly internationally, so the traded products, the price of traded products is fixed by trade with foreign trading partners. And so what this little model tells us, which is really quite elegant, is that the reason why some countries are poor and others are rich is that the poor countries have low labour productivity in tradable goods. That is, they require more worker years to produce a motor vehicle than do the richer countries. And as development progresses, what you find is that they require less worker years to produce that motor vehicle. And the question then is, and this is where the hypothesis leads us, is what happens to the real exchange rate. And so what actually happens is that as fewer workers are required to produce that motor vehicle, the wage rate of those workers can rise. And as the wage rate rises, because we don't have productivity rising in the haircut sector or the services sector, then the price of those services has to rise, and as a consequence the price of all goods and services in GDP on average has to rise, and as a consequence then the real exchange rate should appreciate. Now, when we come to look at China, we find that this hypothesis does not appear to work. We have relatively high in the period, I'm going to look at two particular periods here, 1995 to 2003. 1994 was the year in which the Chinese exchange rate was integrated. Before that, there was high inflation and financial instability. After that, the long period of stability driven by the US dollar peg. And during that period, they had relatively high tradable productivity growth, and that should have told us that the Balassa-Samuelson hypothesis should work, that we should have an appreciation, we should have rising service prices, and in fact we observe rising service prices, and we observe rising real wage growth relative to trading partners, but we do not observe any real appreciation. Then, after 2003, and it seems to be a rather sharp cutoff here, and continuing post the global financial crisis, we have continued high tradable productivity growth, we have continued real wage growth, but we have service price deflation, that is, the services prices are not growing faster than other prices. That tells us that Balassa-Samuelson is not working, and we have rising relative agricultural prices, and that's where we interact closely with Meng's work on the rural wage. And so we have a fairly rapidly appreciating real exchange rate. And these are the prices, just taken as an index based in 1990. You can see that the fat lines on the left through 2003 are the services prices. Those are rising faster than other prices. But then when you take a look at the period from 2003 onward, what you see is that the rural or agricultural prices overall are rising faster than any other. And that makes it quite different, that period. Here is the real exchange rate. On an annual basis on GDP prices, very flat, and then we have this appreciation prior to the global financial crisis. This is the corresponding real exchange rate on producer prices, which gets us closer, because it's mainly manufacturers, gets us closer to the exchange rate as felt by the export sector in China. And the lower red line is the real one. You can see there a long period of depreciation and then a transition to a period of appreciation that occurred in association with the period of appreciating nominal exchange rate. Although that's simply a monetary response to the appreciation in the real exchange rate, which would otherwise have generated much higher domestic inflation. So the story in our earlier work, which is reported in the chapter, about why in that first period we did not have a real appreciation in China, and therefore why it was possible to keep the nominal exchange rate low and stable, and therefore why China came under so much criticism from abroad, was because of two reasons. One, because of the depreciating effects of trade reform, that is, trade reform switching demand away from Chinese goods toward foreign goods. And secondly, and more importantly, because of a high saving rate that did effectively the same thing. Diverted Chinese domestic income into expenditure on foreign assets. And so then that begs the question of why the saving rate's so high. We have had some discussion about that, so I'll move on there. But you can see in this picture the top two lines are the saving investment gap, and therefore a measure of the current account surplus. And you can see that there's a substantial period there during which this gap is rising, the gap between the red and blue lines. During the financial crisis, you see a kick up in investment, which is driven in part by the fiscal stimulus package, and a slight slowdown in the saving rate, nonetheless over 50%. So you have a period in which the gap, the structural gap between saving and investment, and therefore the current account's expanding, and then a period in which it stabilises and during the crisis begins to contract. So that's going to be a story I'm going to skip that one, that relates to why we did have an appreciation between 2003 and 2008. And here I'm just going to do something very quick and then stop before I conclude because time's running out. First, as I said before, in this period, service prices are not inflating relative to other prices, and so we don't have a story, a Balassa-Samuelson-style productivity-driven story. We do have a rise in investment relative to savings, so it would be a current account surplus squeezing down a little, but that can't be the dominant force appreciating the real exchange rate, because if it were, because investment is heavily intensive in services, we would have an inflation in services prices. Instead, we have a labour scarcity story, and we've had lots of discussion about that so far, and there will be more, I'm certain. And we have the standard population slowdown, labour force plateauing, we have the turning point story, but in my view, we also have something that's not been mentioned so far, which is policy-induced improvements to the rural terms of trade. That is, a movement from net taxation of agriculture to protection of agriculture. And one of the pictures that suggests if we take the official data, and I'm reliant on Meng for comments on whether these are accurate, but if we take an average of the rural wage and look at that through time, on a log scale, you can see that there appears to be an acceleration after 2003. In the rural, this is the rural wage rate, this is the wage rate of those people who could migrate to manufacturing. And then if you take a look at real wages in labour destination, rural migrant destination regions, you see, and compare those with the manufacturing wage rates in the regions that they migrate to, you can see that the red lines are the rural wages. Those have, since 2003, at least according to official data, accelerated relative to the manufacturing wages, suggesting a rural labour market tightening. And there are many stories about why protection has increased. I won't go into those in detail, but that's all I've got time to cover now. As I say, if you want to read on about the issue of the renminbi itself and the controversy over the nominal exchange rate, then please refer to the chapter.
Thank you, Ron. What I would do is I would collect 2 questions and then ask the panel to answer them. Chandra and Mr. Sun, Mr. Yue. Chandra? We'll first collect the questions and then...
Chandra from ANU. My comment or question is on Rod's presentation, which relates to Meng's presentation as well. Balassa-Samuelson model assumes a frictionless, smoothly functioning labor market where wages are determined in line with productivity growth. And Meng has convincingly demonstrated that Chinese labor market is very much a reflection of labor surplus situation. Therefore, it is quite natural that you could not find evidence in support of Balassa-Samuelson.
Thank you.
The impact of GFC should be identified as the number of workers who go home and do not return back to work to job. Given there's a GFC minus the number of workers who go home and do not return to job, if there's no GFC. Yes. And of course, since we already have GFC, definitely we will observe the second situation. It seems to me that your 18 million your 18 million estimate do not account for the number of workers who became formed if there is no GFC. It seems to me that's the case.
Okay. Thank you. Then last question is Mr. Yes, sir.
Yeah, thank you. My name is Yu Sheng from Aber. My question actually applied for the whole panel. Actually, during the global financial crisis period, I mean, all the countries using both fiscal and financial, monetary policy to deal with this problem. Well, I mean, according to Ligang's presentation there, we can see for China that fiscal policy seems to be more effective than the monetary policy. Well, as long as, through the whole period, actually, the interest rate, for the term deposit 1 year actually is more stable. Well, for this part of things, in the next 20 years, China need to maintain the current, sustainable economic growth, need to use both of the policy more wisely, actually, to deal with the potential risk. So how China, I would like to see your opinion about that, to what extent China can reform or doing some reforms to increase this effectiveness of the monetary policy in dealing with this type of things, the risks. And also, related to this question is that, is it possible that I know, the same question actually applied to Rod as well, because that we all know that Balasa Samuelson can deal with the long-term real exchange rate. Well, monetary policy is also very important for affecting the fluctuation of that. So is it possible that the flattening interest rate actually is one of the possible reason for this, not appreciation of RMB? Thank you.
Thank you. I'm Professor Alan Martin of the College of Business and Economics at the ANU. Alan Barton, ANU here. I have a question for Professor Ligang Song, and it relates to the global financial crisis and the use of the very incredibly extensive use of the incredibly complex derivatives in that crash. This point is highlighted in Professor Ross Garnaut's absolutely outstanding book on the Great Crash of 2008, and they dominate all world financial transactions. In 2008, according to the International Bank for Settlements, they were approaching $700 trillion, which was about 10 times the size of the world's GDP and 16 times the size of the genuine financial markets in shares and loans and so on. And but virtually all these all this derivative trading was off balance sheet, non-transparent, done through computers and so on, and they're virtually all based on a very modest amount of equity and 95% loans and so on. And of course they collapsed with the collapse of Bear Stearns and then Lehman Brothers and whatnot. Now, my question, Professor, is to what extent are these complex financial derivatives used in the Chinese financial market, as they're used in Wall Street and London and so on? Thank you.
Okay. So each of you get to answer the questions that will make you look good. And choose.
Thank you very much. I think I'd like to address the Sheng Yu's questions is about how to improve the monetary policy implementation in China, in the context about the financial, basic financial settings. I think the difficulty for China now is to, the worry, concern is about export sector, because all the massive migrant workers and most of them are employed in the export sector. So therefore, anything wrong with the export sector will be, quite devastating. So therefore, government, even though you try to, in order to prevent that from happening, the best way is to keep the exchange rate stable rather than, rapidly appreciating the renminbi. So by doing so, the central bank is actually losing that independence of monetary policy. During the past couple, at least 1 decade, at least twice, when the economy, domestic economy is already overheating, but government have to, purchase the foreign exchange in order to issue or to supply the domestic money. Even though central bank is doing the offsetting, which is the sterilization, but through bond market and etc., but still not that effective. So overheating is always a problem. So in order to reform that one, is more comprehensive. For example, you refer to the interest rate changes. Well, interest rates basically still controlled, right? So the banks, commercial bank has a little options to pricing the risk, because of the band is rather relatively narrow. So the way of doing that is actually to improve the whole financial system, including the system in determining the exchange rate as well as the interest rate. That's one. On the financial market, I think it's a very profound question. I think the simple answer is that China is very much, as I said in the presentation, very much unleveraged in terms of financial. So the exposure to the older financial dealing is actually very much limited. That's why the banks looks very robust in the middle of the crisis, because of the low leverage. But on a global setting, it's a very serious problem. So therefore, perhaps down the track, we'll see, as you said, is the scale of that. We'll see plus the stimulus package. We'll see probably in the long run, there's an environment in which the interest, global interest will be relatively high. Thanks.
Let me say one thing that has been mentioned by 2 different speakers, that the government lost monetary control whenever it pegs the exchange rate. But that cannot possibly happen in China without the explicit desire of the government to do so. This is because every bank in China has a credit quota, and the government allows the credit quota to be violated only during politically opportune times, like right before the party election. Right, once the party election is over, all of a sudden, the so-called loss of monetary control disappears every time. So I think that the idea of that pegging the exchange rate causes the Chinese government to lose monetary control is institutionally impossible unless the government chooses to lose control. Meng.
I think there's only one qualifying question. So in the 18 million we calculated, including 11 million, which it's a reduction in the migration between 2 years. And also 7 million we calculated that in the normal year would have increased. So add together, it's the both effect.
Thank you.
Thanks very much. Interesting questions. The first question from Chandra, it's certainly true in my chapter, or our chapter, the Balassa-Samuelson hypothesis is a bit of a straw man because we know it doesn't work in China for lots of reasons. However, it does work on average outside China, and it does, and it is the only widely accepted simple theory about how the real exchange rate changes through time. I think to contrast it with what actually happens in China and think about why it doesn't work there is quite important in our understanding of exchange rate movements for China. And certainly the failure after 2003 is, as Chandra suggests and as Meng suggests, a failure of labour market integration. at least to some extent. Although, as I said in my presentation, I think there is another factor here, and that is increased government assistance to agriculture, and the piling into the WTO's blue box of just about as much as China can get away with so far as assistance to its agricultural sector. And that has improved the rural terms of trade to the point where the marginal product of labour in the, on farms is raised. The other question about monetary versus fiscal policy. During the global financial crisis, we know that, particularly in the United States and in the UK, monetary policy was the first defence, which is, you have a reduction in demand, the tendency is for the price level to fall. We know that that deflation is bad for employment, so what the central banks do is flood the economies with money to keep the price level from falling, to try to keep the company accounts such that they can retain their workforce. The problem was that that capacity was exhausted in both the US and the UK, and it was necessary to resort to very substantial fiscal expansions. Australia was different in that we didn't exhaust our capacity for monetary expansion, but went to fiscal expansion quickly. China is very different again in that in China you have, at least from the government's perspective, a very immature financial and banking system, one that requires the financial stability of which requires the fixed exchange rate and the retention of capital controls. Now, so what you had there was very quickly moving to a fixed nominal exchange rate in China during the global financial crisis, returning to that, a real depreciation which then required a deflation initially during the crisis, and Meng and others have mentioned that, and that deflation required a monetary contraction. The monetary contraction was brought about more by non-interest rate measures, bank reserve requirements and so forth, than by interest rate changes. And then, as the recovery began to develop into 2010, you had a real appreciation starting again. If they were going to retain the fixed nominal exchange rate, that meant they had an inflation. They had to have an inflation, in fact, to retain the fixed nominal exchange rate. So that meant that they had to have an expansionary monetary policy, which then meant they had to maintain very low interest rates. And now we see that they're doing what they should be doing, which is trading off the effects of accelerating inflation in the economy by allowing the exchange rate to, or at least committing to allow the exchange rate to appreciate somewhat. And I think that's all that I was asked.
Thank you very much. By delaying the completion of this session, I've ensured that you will have a very good response to lunch. Thank you.